We got another veteran analyst saying that U.S. equities are, in fact, set for a Santa Claus rally. Veteran analyst Ed Yardeni on Saturday predicted Santa Claus could be coming early to Wall Street this year, saying that U.S. equities are showing early signs of holiday cheer. Always good to see. Remember, Ryan Dietrich thinks there is going to be a Santa Claus rally. Tom Lee was on CNBC this morning. I know he's always bullish, but he was saying maybe even possible up to 7,300 in the S&P cash by end of the year. He also made a pretty bold call that Bitcoin may recapture 100K by the end of the year, but he too thinks that it's going to be a good closeout to the year here, which should culminate in a Santa Claus rally. Yardeni said in his latest note that the stock market's recovery aligns with predictions made on November 23rd. During the holiday-shortened Thanksgiving week, the Dow Jones Industrial Average rose over 4%, the S&P gained nearly 5%, while the NASDAQ surged around 6%. Quote, once their panic selling of Bitcoin subsides, the stock market should recover. That could happen over the next couple of weeks, setting the stock market up for a good year-end rally, end quote. The S&P 500 has risen above its 50-day moving average. We covered that on the chart, indicating a potential climb to 7,000 by year's end. Get those end-of-year targets in. Love to see where they're at. Meanwhile, Alphabet saw its stock price increase following the announcement of its new language model, Gemini 3, which reportedly outperforms competitors and uses more cost-effective Google Tensor Processing Unit chip. Alphabet's Class A shares were up nearly 8% over the previous 5 trading sessions. We talked about that. Google was just an absolute monster trade for a lot of folks here in our chat. I'll be honest, just looking back at my own trading on that, definitely should have held on to some. I was a little too quick on the gun on Google only, but it is what it is. However, AI bellwether Nvidia has not fully recovered, with its stock down by over 2% of the previous 5 trading sessions. Now, last week, even with the truncated week, we did see some bullish call flow for Nvidia around that 190 strike. So we'll see if that turns around here at all. Adding to the optimism, New York Fed President John Williams hinted at a possible interest rate cut during the upcoming FOMC meeting on December 10th. Oh, I had those dates wrong. Excuse me. December 10th and 11th. I think I had it as the 17th and the 18th. My apologies. The NASDAQ also shows potential for reaching a new record high with a 2.5% increase. The recent rebound in the S&P 500 follows a period of market nervousness, particularly around AI stocks. Yardeni previously advised investors to view the pullback in AI stocks as a buying opportunity. He argues that the current market condition contrasts with the late 1990s, where a lack of concern preceded the tech wreck. And that's something that we've covered here, too. There are a lot of folks talking about this being a potential bubble. That's generally not what happens around bubbles. Also, we saw structured outflow of a lot of these tech stocks or high flyer stocks. That's also something that that doesn't really happen in bubbles. That stuff kind of all happens at once, and that does not appear to be the case this time. Now, knock on wood, we'll see how it shakes out for the rest of the year here, but so far, so good. Yardeni had previously noted the potential for a stock market melt-up reminiscent of the late 90s tech boom, driven by factors like softening inflation and a determined Federal Reserve. The sentiment was echoed in Yardeni's previous prediction from October 27th, where the analyst adjusted his predictions for a roaring 2020s bull market scenario. The market recovery also aligns with Yardeni's view on a comparative value of gold and Bitcoin. In a note from October 15th, he described gold as physical Bitcoin, suggesting a shift in investor sentiment, easy for me to say, towards traditional assets amid digital asset volatility. So that panned out. We'll see how much more that has to pan out.